Hi, this is Taylor Nissi with Pleasant Street Wealth Advisors, here with our monthly market wrap. Diversification's been the story this year. It's been a tremendous lesson for investors to keep in mind. The start of the year was a dramatic shift, with U.S. stocks and U.S. growth in particular underperforming, as you can see on the left-hand side of this chart. But that's not been the case the last 3, 5, and 10 years, which you can see on the right-hand side. Since the April 8th bottom, the S&P's turned around, rallying over 25%, but even with the strong recovery, the rest of the world continues to outperform by a healthy margin. Over the next few slides, we're going to share some insights and data to highlight key factors driving markets and some ideas for investors to consider as we head into the third quarter. The outperformance from non-U.S. stocks has been driven by two significant factors. First, the dollar's biggest drop in 50 years. When the dollar drops relative to other currencies, it makes those foreign currencies stronger. And when international companies convert their profits from US dollars back to their local currency, that means they retain a higher value. And that improves their company earnings margin, profit profile, all of that stuff. It also makes their goods cheaper for buyers using US dollars. So again, the net effect boosts their stocks, which is why we're seeing this healthy outperformance from Europe, international developed, and international emerging markets. The second factor here has been uncertainty in the U.S. There's been questions about tariff policy, Fed inaction, and other policy decisions from the White House that's led to pressure on U.S. stocks. Overall, we see currency as a positive tailwind for foreign stocks as we continue through the rest of the year, and U.S. policy remains somewhat questionable, mostly from tariffs. This past weekend, we had the one big bill, as they're calling it, passed into law, which actually, politics aside, is a good thing for markets. The one thing that stocks and companies want is they just want to know the rules of the game. And now that we have clear tax policy, that will be a good benefit for U.S. corporations, allowing them to invest and make some other longer-term strategic decisions now that they kind of know the rules. Global stocks remain attractive from a valuation standpoint, even with the fast start to the year. To be clear, our research does still suggest that the U.S. economy remains the most dynamic and therefore largest weighting in our portfolios. However, this data you're looking at reaffirms and supports our belief that investors should be globally allocated, and you should feel comfortable deploying new capital to global stocks in a manner that's consistent with your investment policy statement. As you can see on the chart here, valuations by country and region, from a price to earnings perspective, a lot of the international markets remain extremely attractive. And with the strong start to the year-to-date performance of the non-U.S. and the sharp recovery the past few weeks in the U.S., we're seeing equities across the board hit all-time new highs. In June, as you can see on the left, the NASDAQ and the emerging markets were the top performance. But if we look on the right-hand side at the trailing 12 months, developed, international, and emerging markets are still leading the way, with U.S. growth stocks playing catch-up. And so let's take a look at fixed income. Fixed income and bonds are also having a historically strong year, boosted by higher yields and an investor's belief that despite some headlines, the economy is still on firm ground. A patient Fed who's slow to cut and the rising likelihood of fiscal stimulus can provide a floor here under long-term rates as we close out the year in 2025. And what that does is the higher starting yields suggest that high-quality bonds could deliver solid returns in the year ahead. The chart you're looking at shows an implied annualized five-year return of 4.56% based on the AG, which is a popular fixed income index, at the end of June. So what this is doing is this is showing us a pretty healthy setup for bonds as a part of your portfolio moving forward. And let's take a look at some quick economic data before we close out with some final thoughts, observations, and opportunities. So unemployment continues to remain low, and this supports a healthy economy. Now, there have been a lot of headlines about layoffs and announcements of layoffs from both the government via DOGE and from corporations, in particular technology companies, laying off folks as they're getting more efficient with AI. But so far, that data really hasn't shown up in the jobs reports, in the unemployment reports. There's two things for folks to keep in mind. Number one, sometimes the headlines aren't accurate with the data. The other thing is, if people are on severance packages, if people aren't actively looking for work, they're not going to be showing up in this data. And one other observation from the last jobs report was still a high percent of those jobs were government jobs versus private sector jobs. We'd like to see a more balanced or even more weight towards the private sector jobs, but we're not seeing that right now. So there is definitely some, cause for more observation here, but at its face value, this is still a strong data point that supports a healthy economy. Similarly, ever since the announcement of tariffs, there have been a lot of calls for inflation as a result of the tariffs and other factors. In June, another month and another quarter now has passed without any uptrend in inflation. You can see, the major inflation data points here on the top chart show us pushing into the mid 2% range. On the bottom, we can see that the Fed is taking a slow wait and see approach. They're not raising rates, they're not cutting rates, they're just kind of keeping them pinned at 4.5%. So this is again another question of, will we see this inflation spike? Will we see that the tariffs eventually impact inflation and consumer costs? And ultimately, when, if at all, will the Fed react to anything? For now, inflation low at 2, that's good. Rates, people are getting by, mortgage market suffering a little bit. But overall, again, this is a relatively healthy data set here for us. What does this setup have our team thinking about? Well, first, over the last 5 years, we've certainly had our ups and downs between COVID, 2022, and the sharp rebound we've had the last 2 years. The net impact has been significant investment gains in some assets, but not in others. And so for investors who are not following a disciplined rebalancing strategy, portfolios have probably grown riskier with a concentration in the most expensive assets. And while we do believe overall this is a positive setup, and we do think that there's greener pastures ahead, which we'll talk about in a second, there's always risk in capital markets. Stocks can drop on a whim 20%, and investors should be reviewing and rebalancing to ensure that they maintain proper diversification to weather any potential storms that might arise in whatever manner is consistent with their investment policy statement. So what else can we do besides rebalance? Well, first, we don't want to have any idle cash sitting around. And between the positive setup from stocks and the implied forward return from bonds, investors should be watching out for carrying too much cash on the balance sheet. And while inflation is relatively low now in the mid-2s, it is still eating away at the purchasing power of cash. And as this chart shows, there is an opportunity cost when it comes to not investing or waiting to time the market. So really the action item here is review your cash levels, and if you have excess cash, if your emergency fund has too much, if all of your spending that you think is going to happen this year, you've already got that in cash, consider deploying some of this cash in a manner that's consistent with your investment policy statement. Now, I did mention earlier that we are at all-time highs, and there's a natural reaction to seeing something at the highest price you've ever seen. And the natural reaction is to say, wait a minute, this is too expensive. I'm going to wait and buy it when it's on sale. However, we had our research partners look at this, and they found some interesting data. And as it turns out, you can see here, if you invest at all-time new highs, your returns tend to be better than all other periods over the 1, 3, and 5-year forward-looking returns, or forward-looking periods. And I know this is counterintuitive, so we wanted to go a little bit further here. But this right here is telling us that if we're thinking about investing in the U.S. stocks in particular, even though they're at all-time highs, we should still feel comfortable doing that as long as we're maintaining an emergency fund and doing all the other things we should be doing to have proper diversification. So one reason investing at all-time highs tends to work is from a market phenomenon called momentum. Market momentum refers to the tendency of rising prices to keep rising, as strong trends often persist due to investor psychology and herd behavior, like FOMO, for fear of missing out. When the stock or an overall market hits an all-time high, it can signal a robust positive momentum, meaning investors are optimistic and willing to buy at higher prices. This momentum effect is really well documented. Assets that have recently outperformed tend to continue their outperformance for a period, which is why buying at all-time highs can be a sound strategy rather than a risky one. In essence, new highs often reflect favorable conditions with little resistance from previous sellers, allowing trends to continue and provide opportunities for further gains. And as you can see on the chart, new highs tend to cluster. And most years in the stock market feature either 10 all-time highs or none at all. And as of today, we're at 7. Another way to look at the momentum in markets is to consider how many trading days there are between pullbacks of 5% or more. And as you can see here, in bull markets, investors who are waiting to buy the dip could be waiting hundreds of days. It's been 30 days since our last 5% pullback. So when the choice is to invest at all-time highs or not invest at all waiting for a pullback, the odds are actually in your favor to invest at all-time highs. Historical data trends suggest a strong second half and forward 12-month returns for the S&P. As you can see here, right, strong return in May, strong return in June. Suggests a good setup for about a 1-2% return in July, 3 to 4% return in Q3, an 8 to 9% return through the final 6 months, and a 15-ish% return over the next 12 months. So we do like the setup here. We do think that clarity on tax policy, some trade deals getting done, hopefully some geopolitical tensions can die down a little bit. And again, currency tailwinds are strong abroad, so that should be good for the global economy. So overall, we are relatively optimistic, but investors do need to keep in mind, even though I just showed you 3 charts saying it's okay to invest in all-time highs, markets rarely move in a straight line. So there will certainly be volatility through the back half of the year. People should make sure they're maintaining an emergency fund, make sure they're taking proper, risk management strategies into account with how they're allocating funds. But we still are very positive about the future for Q3 and capital markets, and we think investors should be taking advantage of these opportunities. Thank you for your time, and as always, I hope you found this insightful and helpful. And if you have any questions or if you'd like to speak with someone about anything we discussed today, you can reach us here or reach out to your advisor, and we'll happily get in touch and take time to talk through these concepts with you. So have a wonderful rest of the month of July, and we look forward to catching up with all of our clients soon.